So, uh, imagine trying to keep a bucket full of water, right? But then the Federal Reserve they poke a hole in the bottom,
Right.
and Wall Street's current obsession with AI just pokes another one. Welcome to the deep dive.
That's exactly what it feels like right now.
Today, we are looking at a pretty massive stack of market data, SEC filings, and network health reports from early August 2026.
And it is definitely a heavy stack this week.
It really is. And our mission today is to figure out why crypto's market momentum just, died so suddenly after a really strong July.
Yeah.
And why, kind of paradoxically, the infrastructure behind the scenes is actually getting much stronger. I'm your host, and joining me to unpack this double front bottleneck is our resident expert. Let's get right into it.
Sounds good. Because, the narrative flip here has been incredibly severe.
Oh, absolutely.
Like, if you look back, Bitcoin ended July up nearly 10%.
Yeah, I was flirting with, $65,000?
Right, exactly. And Ethereum was holding its ground, too. But then it was almost overnight. The momentum just vanished.
Completely vanished.
Yeah, Bitcoin dropped back down to a local bottom of $62,369. And Ethereum lost that really crucial $2,000 support floor.
Which I guess brings us back to that leaky bucket metaphor.
Right.
The first leak draining this market is really just the Federal Reserve, keeping interest rates so high.
Oh, absolutely. The macro environment is everything right now.
Because, when cash sitting in a bank pays a 5% risk-free yield, institutions they simply don't want to risk holding volatile digital assets.
No, they don't. It literally drains the incentive to stay in crypto.
Yeah.
And then the second leak is this massive capital rotation into artificial intelligence and semiconductor infrastructure.
Right. The AI boom is just sucking up everything.
It really is. We're seeing traditional venture capital aggressively pull out of Web3 to chase tech indexes like the Chaos PI, for example. Yeah. And when you combine those high rates with a shiny new tech sector, structural analysts start warning about the historical August crash cycle.
The August crash. Yeah. Historically, August sees an average, 13.6% drawdown?
Exactly.
Yeah.
And that's precisely because macro trading desks just flee to these liquid safe havens.
So, okay, institutional money is fleeing Web3 for AI because of the high interest rates.
Right.
But paradoxically, just as that tourist capital leaves, regulators like the SEC are suddenly treating what's left of the crypto market like a mature traditional financial sector.
Yes, they are.
We saw this with the SEC putting a sudden regulatory hold on Nasdaq's Bitcoin options application.
Right, while simultaneously granting a comprehensive review for CME Group's competing derivatives.
Oh, so picking favorites.
Basically, yeah. The underlying logic here is that regulators are they're prioritizing established traditional institutional pathways over the crypto-native exchanges.
Makes sense.
Yeah, they are shifting from just trying to figure out what these assets are to actually applying strict bank-grade supervision.
And we're seeing that globally with stablecoins, too. Like, jurisdictions aren't just brainstorming anymore.
No, they're taking action.
They really are. They are enforcing actual mandates like 100% reserve backing, segregated customer assets, and explicit fiat redemption rights.
The whole asset class is basically being forced to grow up.
Yeah.
And that regulatory pressure is exactly what's forcing the underlying technology to harden its defenses.
Wait, but look at the EMCD miner program in our sources for a second.
Okay. Yeah.
If regulators are stepping up and the market is maturing, how do we explain proof-of-work miners bleeding out like this?
Well, it's complicated.
EMCD had to inject a $30 million miner support program just to supply operational capital, to keep operators afloat.
Right.
How is that not a massive red flag that the foundational infrastructure is currently failing?
I know it looks alarming on the surface, but it's actually a really robust survival mechanism.
Really? How so?
Well, network difficulty is at near record highs right now, which means it requires significantly more energy and capital to mine.
Right, the margins get squeezed.
Exactly. So the fact that major mining pools can just, deploy tens of millions of dollars to safeguard the network's hash rate that proves the ecosystem has the built-in capital to defend its foundation during a profitability squeeze.
Okay, that makes sense. And I guess despite that squeeze, the actual utility of the networks is expanding.
Expanding rapidly, actually.
Yeah, like CT3 just launched these high-throughput dedicated storage contracts.
Which is a huge deal.
To translate that for everyone, think of it like renting a highly secure, decentralized warehouse for massive amounts of enterprise data rather than just like a small digital locker.
And that expansion of utility is key to surviving the doldrums.
Definitely.
You also have platforms like BitChute Launchpool deploying a 1.1 million AEON token reward pool.
Oh, wow, that's significant.
It is. They are actively utilizing their remaining capital to keep retail users engaged, and the network active while the broader market consolidates.
So if history teaches us anything, I suppose it's that these summer crashes are exactly when the real infrastructure hardens.
Absolutely. It's building season.
Right. Capital might be rotating into AI, and August might be testing everyone's patience, but the foundation is actively defending itself.
And adapting to those strict bank grade rules.
Exactly. So before we wrap up this deep dive, I want to leave you with one final thought to ponder.
Let's hear it.
If traditional tech keeps draining Web3 capital to build AI, will these two sectors eventually be forced to merge their decentralized storage and compute power?
Oh, that's a great question.
Or, are they destined to forever be at war for the exact same venture dollars?
Something to think about for sure.
Definitely. Keep your head clear, and we'll catch you on the next deep dive.